Hello everyone, good morning and welcome to today's edition to 𝐾𝐤𝐴 TV's Executive Corner Expert Talks. I'm your host Sage, and this morning we have with us Mr Herbert Blank, the Senior Quantitative Analyst at 𝐊𝐿𝐴𝐺𝐴. Today's expert will share insights on how 𝐊𝐿𝐴𝐺𝐴 runs complex models across 4,000 US and 1,000 Canadian stocks and 500 exchange-traded funds or ETFs every single day. And as you know, we bring you the industry leaders, successful business owners, all under the one roof to help you discover the insights of the stock markets. So today we're very lucky to share some space with Mr Herb Blank, Senior Quantitative Analyst at 𝐊𝐿𝐴𝐺𝐴. Welcome, Herb.
Thank you, Sage. I appreciate you having me today. It's like old home week looking at the Sydney Harbour Bridge. I got to make 3 visits to Australia on business from '94 to 2000 and I absolutely love Sydney.
Well, it's a pleasure to meet you, and I'm glad you're enjoying the view. Well, with your experience, let's get started. I'm keen to share your insights with our viewers, and thank you for joining us again, Herb. We'd like to know your thoughts on whether building equally weighted portfolios will deliver superior performance or portfolios weighted by market capitalisation would be better. Could you please help us understand that a bit better?
I sure can. There's a lot of academic research which has said that smaller cap stocks in the United States and in other countries and equally weighted rather than going against the cap weighted, going against the wisdom of the market will outperform over time. That was very much true before the market became more efficient in the 60s, 70s, not as much in the 80s. Somewhat in the early 90s, not as much in the later 90s, and then it worked from 2001 to 2007. It didn't work at all from 2008 to the present, basically, except for the last 12 months where value has come back with a bit of a vengeance. RSP, the equally weighted S&P 500 ETF, has outperformed SPY by about 800 basis points, although neither is anything to be ashamed of. The RSP has gotten more than 40% over the last 12 months, but don't feel sorry for the people in SPY who made about 32% on the S&P 500 cap weighted.
Right, well, thank you so much for sharing that insight and the data there. It's interesting to see how so much more interest has been put towards the stock market in the last 12 to 18 months. It seems that people could be using those stimulus checks to maybe invest and learn a bit more about the equities. And the COVID-19 pandemic shook industries. And would you give us a synopsis of exchange-traded funds performance in the past 12 months, which has completely exploded?
Basically, most of them, particularly the S&P 500, went before the last 12 months. To be exact, March 18th through April 25th of 2020 went down about 38%. But they recaptured all of that within the following 4 months, and the market has been flush with money. And Sage, that's very insightful what you said. The stimulus money is a large part of it. People look at earnings, they get lost in a lot of different things. At the end of the day, what makes a stock's price rise and fall? Supply and demand. It's about cash flows. And there was a lot of cash to put it. One of the major factors between the bullish markets in the US, a straight bull market pretty much with a couple of exceptions from 2009 through the present, has been that there's been nowhere else sensible to put the money. Interest rates are very low. The U.S. economy continues to buzz along, and there really is nowhere else sensible to put the market. And even though the market makes more highs every day, and there are analysts that say, okay, it's too high, its price earnings is way too high, its price book is way too high. Guess what? As long as there are cash flows that want to still go into the market and have nowhere better to go, the market's going to continue to go up.
Exactly, and we're seeing a lot of those tech stocks in Australia and even America doing quite well with the digitisation booming. According to you, which sectors' ETFs would be most beneficial in the coming months, and why, if you could?
Okay, there are investors and there are traders. In my opinion, investors in the U.S. market who are going to go for any length of time can't do much better than buying an ETF, exchange traded fund, such as IVV, which has the whole S&P 500, or better yet, VTI, which basically owns the entire U.S. stock market, a Vanguard ETF, and you're paying 0.02% per annum. Basically, you're getting it for free management, and you get the whole market. And over time, it mirrors the cash flows of investors. And as much as some experts try to say the market is stupid, actually, it's not stupid money. It's institutional money. It's the smart money that determines the allocation of market assets to the market stocks. So over time, I can't emphasize how smart a play that is. Now, there are traders and there are people who are trying to get extra return during that time, and that's fine. The sectors that we like very much at 𝐕𝐢𝐴ngine right now include transportation and airlines, and include oil and energy stocks. These value stocks that had been suppressed for very long are doing very well. But at the same time, we give 4 out of 5, our second highest rating, to QQQ, which, as you know, Sage, is emblematic of the tech bubble. The top 7 stocks in it: Microsoft, Apple, Microsoft, Facebook, Google, Amazon, Tesla, and I'm leaving one out, Netflix. Those 7 stocks account for 44% of the QQQ's 100 stocks and drive the performance, and it's driven it higher over the last 12 years than the S&P or anything else. You'd be good to be in any of those things, but you'd have an average return of more than 15% per annum if you've been in QQQ all that time.
Exactly. Thank you so much for sharing that. And the global biotech industry made some life-altering developments. Please, can you talk a little bit more about the significant implications you observed in the industry, and also what you believe their impact will be in the coming years?
Well, again, if you are able to select the biotech stocks, typically take years to develop their technology, to develop their patents, to put things together. Then they go through phase 1 trials, phase 2 trials, phase 3 trials over a period of years. And there are many different methodologies and many different firms, hundreds of them, sometimes thousands of them, trying to get the cures, trying to get the treatments, trying to get all these things at the same time. If you're very smart, very lucky, you can research and try to find the right firm. But the trouble is, if you don't find the firm that gets there first, likely the firm that you selected will be worthless by the time your investment is through. That's why ETFs in biotech are such a good thing. You own all 150. You own all the candidates that are going to be worth money sometime. So XBI is the iShare for the biotech industry, and it has done very well. It's my personal favorite. Another one I like is SBio, which is from 𝐓𝐡𝐞 that owns over 250 biotech stocks in the nascent stage, and a lot of those are also looked at to be by the index methodology to be takeover candidates, and they're very strong. Now we're going to have more active managers using the more efficient ETF structure to select bio and use a combination of the quantitative methods and their own judgment to and risk control, and that's going to be very popular with a lot of people who know that the performance may have been better by all the automated funds over years, but they still would like to have an active manager on the tiller as well.
Exactly. It's been interesting to see how the vaccine stock price has been changing with the recent updates and further rollouts in Australia as well. And the previous
absolutely the vaccines and all these other treatments, breast cancer treatments, brain cancer, there have been T cells, there have been so many developments in the last few years. It's just amazing what the biotech industry has done. It's all about technology. It's all about these new ways of sourcing DNA. I mean, think about these vaccines that have been able to do it with not a single trace of antibody. You have not had to inject any of the coronavirus itself in order to develop these very effective vaccines.
Yes, it's amazing what they're doing with the mRNA and the gene splicing. You're absolutely right. And the previous 20 months have been relentlessly difficult for value managers in terms of relative performance to growth management. Could you give us your expert opinion on how the value managers should stay cautious of such unforeseen circumstances so that growth management is not hindered?
Well, the value managers don't hinder growth. It's just a matter of which can outperform and what's going on. I mean, as long as everyone's buying stocks, both will do just fine. It's just a matter of relative performance. Basically, again, what value is looking at most of the time, price book ratio, things, a lot of it relates to financial statements that have been around since the turn of the 19th century and relate to the model is companies that have inventories, that have factories, that produce physical products that are out there. That pertains to about 35% of the market cap of the S&P today. That's one of the reasons ESG and other ways of looking at intangibles like patents, intellectual property, company reputation, things like that. These are the important assets of firms like Google and Facebook, and even firms that have physical products like Apple and Amazon. It's more about the reputation, the intellectual property, the branding, and the ability to be out in front of the technology more than other companies that make them as unique as they are. So valuation methods that just look at price relative to things like earnings per share going backwards or even projected earnings per share are missing some of the point here.
Right. Thank you so much for those insights.
That's it. Let me just finish up. Value's done well, actually did well for the 12-month period ending June 30th, 2021. Then the last 2 months, it hasn't done as well, but value managers are still doing fine. Growth managers are doing fine. If you're invested in the U.S. market and haven't pulled out because you're afraid of an apocalypse, you've won the game.
Exactly. You can't let your fear hold you back during these times, that's for sure. And we're seeing a little bit of the FUD creeping into the markets, but hopefully the inflation won't be too much of a deterrent. Do you have any last comments on inflation before we go? Do you think it's going to be an issue?
Inflation will be an issue over the next 5 to 10 years to all the markets, not just the stock, and not just U.S. inflation necessarily. Yeah, I mean, right now, though, there are factors exacerbating U.S. inflation. Right now, I think we're on a level of above 6% for the year, aren't we? Which is, crazy compared to what we've had. But a lot of it is because of the backlog of demand that is suddenly being filled alongside the shortage of labor and a shortage of materials being caused by the pandemic. It's a unique kind of period. Do I think that will continue at a 7% rate over the next 5 years? No, I don't see that happening. But there will be inflation. I don't think the 10-year period that we've just had with inflation getting as low as a 0.25%.
Thank you for joining us. This is Expert Talks by 𝐊𝐿𝐼𝐴 TV, and we just had a very interesting discussion with Mr Herbert Blank, the Senior Quantitative Analyst at 𝐷𝐷𝐴. And the full recorded interview will be available from the YouTube channel, where you can gain his insights on some fabulous ETFs and his economic outlook. The YouTube channel is 𝐊𝐼𝐴 Media, but please stay watching for more Expert Talks and live market commentary. And as we say, stay apprised and invest wise with 𝐊𝐼𝐴.